Welcome to the ultimate option trading guide. Trillions of dollars travel through the stock market every day, but did you realize that a significant portion of this trade consists of more than just buying and selling stocks? Today, we'll reveal the secrets of options trading, and if you want to learn how to minimize risks, maximize returns, or simply understand this complex market, you've come to the correct place. Let's dive right in. So, what exactly is option trading? Options trading include buying and selling options, which are contracts that give the holder the right, but not the responsibility, to buy or sell an underlying asset at a certain price within a set time frame. At its foundation, options trading is about obtaining the right to execute a future trade at a price fixed today. It's comparable to having a voucher for a discounted price on your favorite item that you can use before it expires, whether the price of that gadget rises or lowers. Let us now look at some key phrases and concepts that you should be familiar with. Call option. A call option allows the holder to buy the underlying asset at the strike price before or on the expiration date. Assume you're looking for a new smartphone that will be released next month. Buying a call option is equivalent to paying a little amount today to lock in the purchase price for the following month, regardless of whether the phone's price rises due to its popularity. Assume you're bullish about a tech company's stock, which is now valued at $100. You may purchase a call option with a strike price of $105 for a tiny premium, say $3. If the stock price rises to $120, you can execute your option and buy the stock for $105, despite the fact that it is already trading at $120. On the other side, if the stock price falls, you will only lose the $3 premium. Put option. A put option allows the holder to sell the underlying asset at the strike price before or on the expiration date. For example, if you are negative on a company's stock, which is now trading at $100, you may buy a put option with a strike price of $95 for a tiny premium, say $3. If the stock price falls to $80, you can exercise the option and sell it for $95, even though it is presently trading at $80. If the stock price rises, you will only lose the $3 premium you paid. Expiration date. If you do not exercise the option by the expiration date, it becomes worthless. The longer time an option has before expiring, the more valuable it is. All else being equal, an option loses value as it approaches its expiration date, since the likelihood of major price movement reduces. This phenomenon is known as time decay. Strike price. The striking price is the predetermined price at which the asset can be purchased or sold if the option is exercised. When the strike price of a call option is less than the current market price, it is considered in the money. For example, if a stock is trading at $100 and your call option's strike price is $90, the option is in the money. On the other hand, for a put option to be profitable, the strike price must be higher than the current market price. So, if the stock is trading at $100 and your put option has a strike price of $110, it is in the money. Out of money. An option is considered out of the money when its strike price is lower than the current market price. For a call option, this means the strike price is higher than the current market price. For example, if a stock is trading at $100 and your call option's strike price is $110, it is out of the money. In contrast, a put option has a strike price that is lower than the current market price. So if the stock is trading at $100 and your put option has a strike price of $90, it is out of the money. Out of the money options are often cheaper than in the money options. At the money. When the strike price of an option is equal to the current market price of the underlying stock, the option is at the money. This means that there is no inherent advantage or disadvantage in exercising the option at that time. Premium. The premium is the amount that the option buyer pays to the option seller in exchange for the options contract. The risks associated with options are frequently assessed using metrics known as the Greeks, which are named after letters in the Greek alphabet. In layman's terms, the Greeks contribute to the assessment of option premiums by calculating various risks. The most common Greeks are delta, a measure of an option's sensitivity to fluctuations in the price of the underlying asset. Gamma determines delta's sensitivity to fluctuations in the underlying asset price. Theta, often known as time decay, is a measure of how sensitive an option's price is to the passage of time. Vega determines the sensitivity of an option's price to variations in volatility. Rho determines the sensitivity of an option's price to changes in interest rates. There are two primary reasons that traders get drawn to options. The first step is to restrict the potential downside. When you purchase an option, you can only lose the premium you paid. This contrasts sharply with stock ownership, where the potential loss might range from minimal to catastrophic, depending on the stock's performance. With options, your risk is clearly defined and capped at the premium, providing an additional layer of protection against unexpected market fluctuations. The second is leverage. Options trading allows for a lower financial commitment with the possibility of bigger profits. This is because options allow you to control a larger amount of shares for a relatively little investment, the premium. If the stock rises in your favor, the premium can provide a significant percentage return. However, if the market does not move as planned, you will only lose the premium paid, making it a calibrated risk with a clear maximum loss. Now let's look at some options trading methods. Buying or long calls. Assume you have a strong belief that the stock of a specific company, let's call it Rocket Corp, currently trading at $50, will skyrocket next month due to an anticipated innovative product release. Purchasing a call option may allow you to profit from the possible surge without having to pay the entire price for the stock. So you decide to buy a call option with a strike price of $55, expiring in a month, for a premium of $2 per share. This contract allows you to acquire Rocket Corp shares at $55 per, regardless of how high the stock price rises. If your forecast is true and the stock price climbs to $70, you can exercise your option by purchasing the shares at $55 and then choosing whether to hold it or sell it at the market price of $70. Your profit would be computed as follows. Take the current $70 market price minus the $55 strike price and then subtract the $2 per share premium, which is $200 for $100 shares. This gives you a net profit of $30 per share or $1,300 in total if you have 100 shares. Buying or long puts. Assume you feel Rocket Corp's stock, which is now priced at $50, is poised to drop due to negative market rumors. In this example, you may buy a put option with a strike price of $45, a $2 premium per share, and the same 1-month expiry. This contract allows you to sell Rocket Corp's stock for $45, even if it falls below $30. If the stock price falls substantially, you can exercise your put option. Your profit would be computed by subtracting the $45 strike price, the $30 current market price, and the $2 premium. This would give you a $13 profit per share. Again, as with call options, you can sell the options contract for a profit rather than exercising the option. Covered calls. A covered call strategy occurs when an investor owns a stock and sells a call option on the same stock. Covered calls are an excellent technique to safeguard an investment against a drop in value while simultaneously earning money from the premium paid. This method is particularly popular among investors trying to generate additional income on stocks they intend to hold. This is how it works. Assume you hold shares in Blue Sky Technologies, which is now trading at $100. You are enthusiastic about the company's long-term prospects, but you do not anticipate major price movement in the near future. To profit from the projected stagnation, you decide to sell a call option on Blue Sky Technologies with a strike price of $110 that expires in 1 month, for a premium of $3 per share. The beauty of covered calls is their ability to provide a cushion against minor declines in the stock price because of the premium. If Blue Sky Technologies stock continues below 110, the option expires worthless, and you keep the premium, increasing the value of your investment. However, if the stock rises above $110, you may have to sell it at that price, potentially missing out on bigger returns. Essentially, you are surrendering the prospect of further gains above the strike price for an instant return. Protective puts. The protective puts technique serves as an insurance policy for your stock investments. Suppose you've made significant profits on your Green Earth Innovations shares, which are now worth $150 each. While you are hopeful about the future, you are apprehensive about potential market volatility, which could wipe out your hard-earned profits. To protect your stake, you buy a put option with a strike price of $140 that expires in 3 months for a premium of $5 per share. This protective put restricts your possible loss to the difference between the current stock price and the put's strike price, plus the premium paid. If Green Earth Innovation stock goes below $120, you can execute your option to sell at $140, greatly reducing your loss. However, if the stock price remains unchanged or rises, the premium paid for the put diminishes your net profit. Essentially, you are paying for peace of mind, knowing that regardless of market fluctuations, you'll have a predetermined exit strategy to protect your original investment. Both covered calls and protective puts demonstrate the delicate balance of risk and profit in options trading. Covered calls allow you to generate money from your existing stock investments, but they may result in missed opportunities for larger returns. Protective puts, on the other hand, provide a safety net against market downturns, guaranteeing that your losses are not catastrophic, but at the expense of the insurance premium. Thank you for watching. If you found this options trading guide helpful, please like and subscribe to our channel, Trader Yoda, for more insights and strategies. Bye for now.